Okay, so you bought a house in 2021, or 2020, or maybe you refinanced right at the bottom, right when rates bottomed out, at levels nobody had seen in the history of American mortgage lending. You locked in a rate starting with a 2 or a 3 on a 30-year fixed loan. And for a while, that felt like nothing more than good timing, a nice number on a piece of paper. It did not feel like a decision that would reshape your entire relationship with the housing market for the next decade. Sounds almost too small to matter, almost insultingly minor, a rounding error on a monthly statement. And that is exactly the problem, because that interest rate, sitting quietly on your mortgage document, has become one of the most powerful forces distorting the American housing market in modern history. It is not a rounding error, it is a wall, and tens of millions of people are trapped behind it. Here is what the numbers actually look like. According to research published by the Federal Reserve Bank, the majority of outstanding U.S. mortgages carry an interest rate below 5%. A large share of those, more than a third of all outstanding mortgages, carry a rate below 4%. Meanwhile, the rate on a new 30-year fixed mortgage has spent most of the last 2 years hovering between 6.5% and 7.5%. That gap, the space between what existing homeowners are paying and what they would pay if they sold and bought again, is called the rate lock-in effect. Real estate analysts at Redfin and other major brokerages have estimated that a majority of American homeowners with a mortgage, more than 60% by some measures, are sitting on a rate at least 2 percentage points below the current market rate. That is not a minor inconvenience. That is the difference between a monthly payment you can afford and one that fundamentally does not work for your budget, and it is freezing an entire market in place. So let's actually go inside this and understand what a rate lock really costs someone, because most people who have never run the math have no idea how brutal the number actually is. Start with the basic mechanic. A mortgage payment is a function of 3 things: the loan amount, the interest rate, and the term. Homeowners fixate on the loan amount, how big a house can I afford, but the rate is doing more work on your monthly payment than almost anyone appreciates. Take a $400,000 mortgage on a 30-year fixed term. At 3%, the principal and interest payment is roughly $1,686 a month. At 7%, that exact same loan amount costs $2,661 a month. That is a difference of $975 every single month, for the same house, the same loan size, the same term. Over the life of the loan, that gap compounds into more than $350,000 in additional interest paid for owning the identical property. The house did not get bigger. The house did not get better. The only thing that changed is the number printed on the loan document. And that single number moved the total cost of ownership by more than the price of a second home. Now, understand what this actually means for someone who already owns a house at a low rate and is considering moving. It is not simply, I would pay more for a new house. It is, I would pay more for a smaller, worse, more expensive house than the one I already have. Imagine a family in Denver who bought their home in 2020 with a $350,000 mortgage at 2.9%. Their monthly payment, principal and interest, is around $1,455. Now imagine they want to move, maybe for a new job, maybe because they need more space for a growing family, maybe just because they want to. To buy a comparable home today, given several years of price appreciation, they would likely need to borrow closer to $420,000. At today's rate, near 7%, that new loan costs approximately $2,795 a month. That family is being asked to pay $1,340 more every single month for a home that in many markets is not meaningfully bigger or better than the one they are leaving. This is the calculation running quietly in the back of millions of American minds, and for most of them, the math simply does not work. So they do not move, they stay. This is the single most important thing to understand before you look at any housing market data point from the last 3 years. The market is not behaving normally because a huge share of its potential participants have been financially removed from the game. Existing homeowners are not selling because selling means giving up their rate, and giving up a sub 4% rate to buy into a market at 7% is not a lateral move. It is a financial loss disguised as a housing decision. Let's talk about why this happened, because the mechanism matters. In March 2020, the Federal Reserve cut its benchmark interest rate to near zero in response to the pandemic, and simultaneously began purchasing massive volumes of mortgage-backed securities to keep credit flowing. That combination pushed 30-year fixed mortgage rates down to historic lows, dipping below 3% at multiple points through late 2020 and into 2021, the lowest levels recorded since Freddie Mac began tracking the data in the 1970s. Tens of millions of Americans either bought homes or refinanced existing mortgages during this window, locking in rates that, in retrospect, were a once-in-a-generation anomaly. Then, starting in early 2022, the Fed reversed course sharply, raising rates repeatedly to fight the highest inflation in 4 decades. Mortgage rates, which track loosely with the 10-year Treasury yield plus a spread, followed upward, and followed fast. By late 2022, the average 30-year fixed rate had crossed 7% for the first time since 2002. It has stayed roughly in that 6 to 7.5% range through 2023, 2024, and into 2025 and 2026. The gap between what tens of millions of people locked in and what the market now demands did not close. It has remained wide for years, which is what turned a temporary anomaly into a structural feature of the housing market. Now, let's talk about what this actually costs the economy, because the effects ripple far beyond any individual family's monthly budget. The first cost is inventory. Housing economists refer to this as the lock-in effect on supply, and it is measurable. Research from the Federal Housing Finance Agency has found that homeowners with a rate more than 2 percentage points below the market rate are significantly less likely to sell in any given year, compared to homeowners near the market rate. When you remove a large share of would-be sellers from the market simultaneously, active listings drop. Fewer homes get listed. Fewer homes means less competition among sellers, which means prices stay elevated even while affordability, driven by rates, gets worse for buyers. It is a strange, self-reinforcing loop. High rates are supposed to cool prices by reducing what buyers can afford. But high rates are also keeping sellers off the market, which keeps supply artificially tight, which keeps prices from falling the way basic supply and demand would predict. The lock-in effect is partially why home prices did not crash the way many forecasters expected when rates first spiked in 2022. Supply simply vanished before demand had the chance to properly correct it. The second cost is labor mobility, and this one is less visible but arguably more damaging to the broader economy. Historically, one of the great strengths of the American labor market has been geographic flexibility. People move for better jobs. They move for promotions, for career changes, for entirely new industries opening up in different cities. Economists at the Federal Reserve and various academic institutions have published research suggesting that rate lock-in is measurably suppressing this kind of mobility. If moving to accept a better job means trading a $1,500 mortgage payment for a $2,800 one on a smaller or comparable house, many people are simply declining the opportunity, or negotiating to stay remote, or turning down the promotion that would require relocation. When millions of individual households make this same calculation, the aggregate effect is a labor market that allocates talent less efficiently. Jobs go unfilled in growing cities. Workers stay underemployed in shrinking ones. The friction is invisible in any single data point, but shows up in slower regional wage convergence and stickier local unemployment rates in markets that would otherwise be absorbing new workers. If you're finding this breakdown useful, consider subscribing and dropping a like. It genuinely helps this kind of content reach more people, and there is a lot more of this coming. Here's the part of this story that most people miss entirely, and it is genuinely one of the strangest features of the modern housing market. The lock-in effect does not hit all homeowners equally. It is deeply concentrated among people who bought or refinanced in a very specific 24-month window, roughly mid-2020 through late 2021. If you bought before that window, in 2018 or 2019, your rate was probably somewhere in the 4% range, uncomfortable relative to today's environment, but not nearly as punishing. If you bought after that window, in 2023 onward, you already accepted a 6 or 7% rate as your starting point, so there is no gap to lose by moving. It is specifically the people who happened to transact during that narrow pandemic-era window who are now the most financially frozen. Estimates from mortgage industry analysts suggest that roughly 60 to 65% of all outstanding mortgage debt in America carries a rate below 5%, and the single largest cluster of that debt, tens of millions of loans, sits between 2.5% and 3.5%. Almost all of it originated in that 18 to 24-month pandemic window. An entire generation of homeowners got handed a financial advantage by accident of timing, and that same accident is now the reason they cannot move without financial pain. Good luck and bad luck arrived through the exact same door. Now let's build the actual financial model, because the abstract version of this story undersells how large the numbers get at scale. Take a household earning $95,000 a year, roughly the median household income in a mid-sized American metro. Under conventional lending guidelines, a lender wants total housing costs, principal, interest, taxes, and insurance to stay under about 28% of gross monthly income. That gives this household a housing budget of roughly $2,217 a month. At a 3% rate, that budget supports a mortgage of approximately $525,000. At a 7% rate, that same monthly budget only supports a mortgage of approximately $333,000. That is not a small difference. That is a $192,000 reduction in purchasing power for the exact same household income, driven entirely by the change in interest rate. A family that could have comfortably qualified for a $600,000 home in 2021 might now only qualify for a $400,000 home, even if their income has grown in the meantime. Multiply that dynamic across tens of millions of households simultaneously, and you get a market where an enormous share of potential buyers have simply been priced out of the homes their income would have supported just a few years earlier, not because their income fell, but because the cost of borrowing more than doubled. Now overlay that with the seller side of the equation, because that is where the lock-in effect turns from a personal budget problem into a national supply crisis. The National Association of Realtors has tracked existing home sales, transactions of homes that already exist, as opposed to new construction, and those figures have fallen to some of the lowest annual levels recorded since the early 1990s, even though the total number of households in America and the total number of existing homes has grown enormous amounts since then. Fewer transactions with a much bigger population means the turnover rate of the American housing stock, the percentage of homes that change hands in a given year, has dropped to some of the lowest levels ever recorded. Normally, a healthy liquid housing market sees somewhere around 4 to 5% of the housing stock change hands annually. Recent data has shown that figure closer to 2.5 to 3%, roughly half the normal churn. That is not a market correcting, that is a market seizing up. Let's talk about the volatility angle, because this situation has a genuine historical precedent, and it did not end quickly the last time it happened. In the early 1980s, mortgage rates in the United States spiked above 18%, an almost unimaginable number by today's standards, as the Fed under Paul Volcker aggressively fought runaway inflation. Homeowners who had locked in mortgages at 7 or 8% in the prior decade found themselves in an early version of the exact same trap, unwilling to give up a rate that now looked incredible by comparison. Housing turnover collapsed through the early and mid-1980s. It took years, not months, for the market to normalize, as rates gradually declined through the decade, and the gap between old rates and new rates slowly narrowed. The lesson from that period is uncomfortable for anyone hoping this resolves quickly. Lock-in effects do not dissolve because people get tired of waiting. They dissolve because rates eventually fall enough to close the gap, or because life events, job loss, divorce, death, family growth, force people to transact regardless of the financial penalty. Absent a significant and sustained drop in mortgage rates, economists broadly expect elevated lock-in effects to persist for years, not quarters. Here are the underestimated costs that rarely make it into the headline conversation about this topic. The first is the renovation surge. Homeowners who cannot afford to move but need more space are increasingly choosing to renovate instead. Spending on home improvement and remodeling has stayed remarkably elevated even as home sales have fallen, because addition and renovation, while expensive, is often cheaper than trading a 3% mortgage for a 7% one. The second is the rise of home equity borrowing as a substitute for moving. Homeowners are increasingly tapping home equity lines of credit to fund renovations rather than selling and buying new, because a HELOC on a portion of the home's value does not touch the low rate sitting on the primary mortgage. The third, and this one is genuinely underappreciated, is intergenerational housing pressure. With fewer existing homes coming onto the market, first-time buyers are increasingly competing for a shrinking pool of available inventory, which keeps entry-level home prices elevated, even in a high-rate environment that should theoretically be cooling demand. The lock-in effect is not just freezing existing owners in place, it is actively making it harder for the next generation of buyers to get in at all. There's a real case study that illustrates exactly how this plays out at the metro level. Austin, Texas, saw enormous price appreciation and enormous inbound migration through 2020 and 2021, driven partly by remote work flexibility and partly by tech sector relocation. A huge share of the homeowners who bought during that boom locked in rates near the historic lows. When the Fed began raising rates in 2022, Austin's housing market cooled dramatically faster than most other major metros. Prices actually declined from their peak in several Austin submarkets, one of the sharpest local corrections in the country. But even with prices falling, transaction volume did not recover the way a normal price correction would predict. Sellers who had locked in ultra-low rates during the boom simply refused to sell into a falling market while also facing a rate increase, creating a rare and strange combination: falling prices and near-frozen transaction volume happening simultaneously in the same market. That is the lock-in effect visible in a single city's data, a market that behaved nothing like historical patterns would suggest, because an entire category of normal seller behavior had been financially disabled. Let's be precise about how deep this trap actually runs. Someone with a $300,000 mortgage at 2.9%, who wants to move to a comparable home today, is not just facing a higher payment. They are facing the loss of a financial asset that does not show up on any balance sheet, the present value of that below-market rate over the remaining life of the loan. Financial analysts have attempted to quantify this, essentially treating the locked-in rate as a kind of hidden financial instrument, and the results are striking. For a homeowner roughly 25 years into a 30-year mortgage's remaining term, the value of holding a rate 4 percentage points below market can be worth tens of thousands of dollars in present value terms, money that simply evaporates the moment they sell and originate a new loan at the market rate. That is a real quantifiable cost of moving that has nothing to do with realtor commissions, moving trucks, or closing costs. It is purely the cost of giving up cheap debt. Let's close with the two scenarios, because this is where the human stakes become clear. The optimistic case: mortgage rates gradually decline over the next several years as inflation cools further, drifting back toward the 5% range. As the gap between locked-in rates and market rates narrows, the financial penalty for moving shrinks. Housing turnover slowly recovers toward historical norms. Inventory gradually loosens. First-time buyers see somewhat more competition eased. It is not a dramatic unlock, but a gradual thaw over several years, consistent with how the 1980s lock-in period eventually resolved. The realistic case: rates stay range-bound in the 6 to 7% zone for an extended period, because inflation proves stickier than hoped, or because government borrowing keeps long-term yields elevated. Millions of households who need to move, for jobs, for family changes, for downsizing in retirement, are forced to either absorb the payment shock or delay life decisions indefinitely. Housing turnover remains near record lows. First-time buyers remain squeezed between elevated prices and elevated rates simultaneously, with no relief from either direction. The gap between the optimistic case and the realistic case is not measured in a single statistic. It is measured in millions of individual life decisions, delayed, downsized, or abandoned entirely, because the math on paper simply refused to work. Here is what this actually is, once you strip away the headlines about a hot or cold housing market. It is not really a story about home prices. It is a story about an entire generation of debt that got mispriced by an emergency monetary policy response, and is now taking years to work its way back through the system. Every family staying in a house that no longer fits them, every worker declining a job in a city they would otherwise move to, every first-time buyer competing for a shrinking pool of starter homes, All of it traces back to the same root cause, a 24-month window in 2020 and 2021 where money became historically cheap, and the years since where it became historically expensive again. The rate you locked in was never just a number on a document, it was a claim on your future flexibility, and for 60% of America, that claim has quietly become a cage. If you want to go deeper on how monetary policy reshapes markets like this one, check out the detailed guide linked in the description and pinned in the first comment. It breaks down the mechanics of interest rate policy and how it ripples through everyday financial decisions far beyond what we covered here. If you found this breakdown valuable, please like the video and subscribe if you haven't already. It genuinely helps the channel grow, and there's a lot more coming.